Welcome to S&P Capital IQ's monthly loan market overview clip. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent market trends and discuss the outlook for February. In preview, the market's technical bias improved further in January, sending secondary prices higher and new issue clearing yields lower. Looking ahead, most players expect the market to retain a healthy tone, assuming away an exogenous shock from Europe or some other quarter. The S&P LSTA index climbed 2.2% in January, its best monthly performance since October. In part, the market rode the overall bull wave that carried the S&P 500 up 4.5%. Closer to home, demand for loans simply outran supply. Supply was light indeed in January. Arrangers closed just $5.6 billion of new institutional loans, the lowest figure since September. That was hardly enough, in fact, to replace loans that have repaid, not to mention keep pace with new inflows. Of course, tone is set as much by expectations as current conditions. Here, too, the view appears bullish. Though the forward calendar has filled in a bit in recent weeks, late January brought a spike in liquidity in the form of bond takeouts. LCD News reported on no fewer than 9 such executions totaling $2.6 billion. That follows a near 6-month drought of bonds issued to repay institutional loans. These trends explain why the average bid of LCD's Flow Name Composite, a measure of the 15 most liquid loans in the market, rose 4 points to 97.6 between year-end and January 31st. The rally was most pronounced at the distressed end of the spectrum, where the prospective returns and potential risks are greatest. The same pattern was true for the broader index, where defaulted loans ripped the cover off the ball in January, posting an 8.4% return. In the new issue market, the story was similar. With too many dollars chasing too few deals, average clearing yields for regular way loans sank to a 6-month low of 6.1% from 6.8% in December. Drilling down, double B loans generally cleared in a 4.5 to 5% range, while single B loans printed in a 5.5 to 6.5% band. The strength of the U.S. market brought forth a spike in Yankee bonds and loans from European issuers facing challenging conditions at home. In all, European issuers announced $13 billion of U.S. dollar financing, far and away the most ever. Participants think this trend will persist, what with the EU's long debt crisis weighing on the capital markets there and regulatory uncertainty keeping European CLO issuance and bank lending in check. The loan default rate inched up to 21 basis points in January from a near record low of 17 basis points at year-end. As mentioned last month, managers expect the rate to rise to around 2% in 2012. Needless to say, if the EU situation deteriorates, all bets will be off. To wrap up, a few final points. As mentioned earlier, M&A-driven activity remains light, with LBO deal-making stuck in first gear. Instead, issuers are focused on opportunistic transactions. For January, for instance, dividend-related financing popped to a 6-month high of nearly $2 billion. Likewise, issuers announced high-yield takeouts that will repay $2.6 billion of institutional loans, the most since last May. And Community Health and Caesars breathed new life into the amend to extend trade. The CLO market gained more traction in January. All told, 3 managers inked $1.1 billion of new vehicles. The latest deal, a $410 million execution from LCM, was particularly encouraging because its AAA tranche cleared at a recent low of 148 basis points over LIBOR. Amid declining funding costs, managers say there are now about a dozen CLOs in market, the most since 2007. While nobody's expecting a surge of issuance anytime soon, the prospects for a steady pace of $1 to $1.5 billion a month in new vehicles seems good for now. Finally, as mentioned, a growing number of European issuers are taking advantage of muscular demand from U.S. accounts to issue Yankee bonds and loans at lower yields than those available in their home markets. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description below. You can also download this presentation at slideshare.net.